Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can get a free digital copy today by going to www.howtoretireontime.com, or you can grab a physical copy on Amazon. Just search for How to Retire on Time. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to finance, we can pretty much talk about it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational as in not financial advice. If you want personalized financial advice, you can request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is Mr. David Franson. David, thanks for being here.
Yes, always happy to be here. David's
going to read your questions, and I'm going to do my best to answer them. You can always text your questions in to 913-363-1234. Again, that number, 913-363-1234. Or you can email us at heymike@howtoretireontime.com. Let's begin.
Hey, Mike, can you explain why some rates, like savings rates, are going down while other rates, like mortgages, are still higher than normal?
So can I ask you, because this is not your specialty in the business.
It's not.
I don't want to make you look dumb, but I'm just curious. So
okay.
Asking for a friend, if you were to ask your friends, there you go. I think we've talked about it, but if you ask your friends, what do you think they would say?
Oh, like on this question here,
if
how
you
would
had,
they explain that?
If you had to guess, why are mortgages still at a higher rate?
So I think probably a lot of people would think that mortgages are tied somehow to what the Fed rates are, right? You hear about, is it Jerome Powell? He always saying, we're going to cut rates a quarter of a basis point. I don't know, right?
Yeah.
And so that's
those small, little bitty cut.
So I think a lot of us kind of think like that's linked together. Like, oh, well, if he'll just lower the overnight rate, whatever it's called, then my mortgage rate will go down and I can buy a house finally or whatever.
Yeah. And so we're all waiting for good old Fed Chair Powell to drop rates.
Right.
So, okay. My suspicion has been confirmed.
Oh, yeah.
So the Fed operates off of the overnight rate. That's basically the rate that helps fuel banks, okay, or other large institutions that would qualify for such, okay? And the financial plumbing or how all of that works is insanely complicated, but it's what puts stress on the financial plumbing. It's not an original term. It's often used in the industry of basically how the money can circulate through, okay? He can make money more expensive or he can make money cheaper, which affects more the banks, the high yield savings, all of that, as money is flowing at a very short-term rate.
That's why money is called a currency, right? Because it's moving around like an electrical current.
Yeah. I've never heard that expression, but I kind of like it. So now you have mortgage rates and auto loans. So the average person, their mortgage is around 7 to 10 years that they're going to keep the mortgage, and then they're going to sell the house and move somewhere else or pay it off or whatever. Some people made all 30 years of their payments, or maybe they in the 7th year, moved to a 15-year and sped things up. I mean, things happen, but it's around 7 to 10 years that people actually hold their mortgages until something happens. So who issues the 10-year Treasury or treasuries in general? The Treasury Department.
Not Jerome Powell.
No, those are separate entities.
They're like down the street from each other, probably, right?
Gosh, I forget who the new Treasury Secretary is. That person, whoever that person. Like, would you look up who the Treasury Secretary is? I forget who it is in Trump's, because Janet Yellen was, I believe, released.
That's right.
Anyway, so this person, we'll find out in just a second, their job is real simple. They're trying to basically issue debt so the government can afford things. That's what a treasury is. It is a debt instrument that says, hey, people of the world, because it's not just the United States that will buy treasuries. If you were to take on part of our debt, we will issue a coupon rate at a competitive rate. Okay, now let's just say I need to raise $500 billion just for an arbitrary number.
Okay,
I'm going to issue $500 billion, just making this up, of treasuries. And now I'm going to give you, David, 1% coupon on that.
Okay.
Do you think you'll actually...
I don't know. It's just like a 1% rate of return.
1% rate of return.
Seems kind of low.
Year-over-year coupon.
Yeah.
When you could go out to a CD and get a CD for 3-4%. You could go to the stock market. You could do private lending at 3-4-5%. No one would take it. So then this person, do you know who the person is?
Yeah, his name's Scott Bassett.
Thank you. That's it. Yep, Scott. So Scott's now saying, all right, How about 2%? And the market's like, nah, pass. 3%? No. You guys have a lot of debt. I'm kind of concerned that you'll default. When I say default, it's not that they won't pay the debt back. It's default means they skipped a payment.
Okay.
They just missed one of their payments. That's it. Yeah. Default is not nearly as concerning as a lot of people think. Yeah, it hurts the credit. There's a lot of negative consequences of it, but a lot of people assume default means they lost their money. Default just means they missed a payment or a few other things could happen. I mean, yeah, I guess if the end of the world happened, that is a possibility. But when people say default, they often misunderstand the term as it's being literally defined. Anyway, okay. So then Scott goes out and says, all right, well, how about 4%? And then the market goes, you've got our attention, but can you do a little bit better? And then he says 4.2%. The market says, how about 4.3? This isn't an actual negotiation. He just knows he needs to get 500 billion or 100 billion or a billion, whatever the dollar amount is, to basically keep things going. So he has to issue treasuries at a competitive rate that's really controlled by what the market is willing to pay for.
Okay.
So Fed Chairman Powell does his own thing that affects the banking industry, which is like high yield savings, maybe some CD rates and all that. But the loan industry is more built around 10-year treasuries, which is based on market sentiment. So if you want lower loans, better rates, you're not necessarily looking at Powell. You're looking at the market, the American debt, and can we pay the debt down fast?
Okay.
If we can pay the debt down fast, there's a reasonable chance that mortgage rates will also go down because a treasury is less risky because the debt is down. America's more solvent, more financially stable. That's why they're separated. Now you need to understand reinvestment risk with all this. So anything that's more associated with the Fed's rates has a lot of reinvestment risk. So a 1-year CD, well, what's it going to be like in 1 year? What's it going to be like in 2 years? Those rates could go up or down. So when you got fixed CDs, right, your standard CD, a fixed annuity, you've got bonds, maybe not bonds, but like the short-term stuff. That's more affected by Powell. The longer-term stuff, bonds, longer-term fixed annuities, structured notes, those instruments, mortgage rates, the loan industry might be more affected by long-term treasuries.
Okay.
Or what the market feels is appropriate. Because no lender is going to take more risk than they need.
Right.
So everything's priced according to market sentiment.
Okay. Very illuminating. The error of our ways has been revealed.
And for everyone in Kansas City right now listening up, I just want to point out something. If you have a lot of CDs, if you got a lot of money in high yield savings, I want to just give you a word of warning or some caution here. That's a huge potential risk when it comes to reinvestment risk. There are other ways to prepare for potential market crashes, other ways to prepare for potential market volatility that could have more long-term upside potential so you can grow and still try to outpace inflation. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcast. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.